Welcome to This Explainer. We're diving straight into a massive question every single saver and investor is staring down right now as we look toward the future, the 2026 asset allocation blueprint. We're looking at the ultimate showdown, equity versus debt. If you've ever wondered exactly where you should be putting your money to truly secure your financial future, well, you're definitely in the right place.
For decades, we've basically been programmed to think stuffing our cash in the bank is the ultimate responsible move. It feels safe, right? The balance never goes down. But our source material absolutely shatters that illusion with a pretty provocative truth. Keeping your money in a savings account is slowly making you poorer. Think about this. Over the last decade, inflation has quietly devoured roughly 30% of the dollar's purchasing power. There is a silent dynamic working against your wealth every single day that your cash just sits there.
So, you're probably wondering, how on earth can doing the responsible thing actually wreck your wealth? It's a completely fair question. To figure this out, we've got to look past the nominal numbers you see when you open your banking app and really unpack the harsh economic reality of what that idle cash can actually buy you over time.
All right, let's get into Section 1, the savings account trap.
Or, as it's perfectly subtitled here, the silent wealth killer.
Moving right along to Section 2, equity versus debt. This is your financial arsenal.
Okay, so to fight back against this wealth erosion, you've got to put your money to work. What's really fascinating here is how equity is defined simply as ownership. When you buy stocks or real estate, you're not just holding cash, you literally own a slice of an asset. And because you're an owner, you get to ride the upside. If the company innovates or profits surge, the value of your stake grows right along with it. It's your path to massive growth potential, though, you do share in the risks too.
Now contrast that with debt. Here, you step into the role of the lender. Instead of owning a piece of the pie, you're basically letting a corporation or even the government borrow your money for a set period of time. In exchange for that, they promise to pay you back with a fixed amount of interest. With debt instruments like bonds, you're trading that massive upside of equity for pure stability and predictability. You know exactly what you're going to get and exactly when. And this sets up the fundamental choice you have to make. Equity offers ownership and high growth potential, while debt puts you in the lender's seat, offering fixed income stability. It's risk and reward versus safety and predictability. Understanding this dichotomy? It is absolutely crucial. It's literally the cornerstone of building any successful financial strategy. Which brings us to Section 3, real returns over time. Let's look at the data showdown.
This is where those concepts hit hard, historical reality. We're looking at real returns, which, if you know the space, you know is the vital metric of how much your money actually grows after adjusting for inflation. Notice how the savings account frequently dips into negative territory. Why? Because the tiny bit of interest it pays is just eaten alive by the rising cost of living. Debt provides modest, steady growth. But look at equity. Historically, taking on that ownership risk is exactly what actively drives substantial wealth-building returns.
This isn't just about abstract numbers on a spreadsheet. This is the reality of your actual purchasing power. If your returns don't outpace inflation, the amount of groceries, housing, or just life experiences you can buy literally shrinks every single year. This trajectory proves why cash is definitively not king for long-term growth. Mathematically speaking, sitting entirely in cash works against your future self.
All right, let's talk solutions. Section 4, your asset allocation blueprint and how we actually design your 2026 portfolio.
Now that we know exactly why our wealth is at risk, we need a game plan. Your ideal blueprint entirely depends on a few deeply personal factors. First up is your risk profile. How comfortable are you with seeing your portfolio's value bouncing around? Second is your financial timeline. Are we talking about saving for a house in 2 years or retirement in 20? Your ultimate goal here is finding your own personal balance on that sliding scale between growth, which is equity, and stability, which is debt.
Let's see how this actually plays out. If you're risk-averse or maybe your timeline is just super short, your portfolio is going to look a lot more like this conservative profile. Notice how heavily weighted it is toward debt. The vast majority of your money is acting as a lender, locking in fixed income to prioritize preserving your capital. You've got a small slice of equity in there just to fight off inflation, but the main job here is protection over aggressive growth.
Conversely, an aggressive 2026 portfolio flips that allocation entirely. If you have a high tolerance for risk and a really long time horizon before you need to touch that money, you'd lean heavily into equity. You're taking a massive ownership stake, accepting those short-term bumps in the road to maximize those towering historical real returns we looked at earlier. And you've just got a tiny slice of debt in there to provide a little bit of ballast.
So, we've seen the silent trap of the savings account. We've explored your financial arsenal. And we've looked at the stark reality of historical returns. Now, it comes down to you. Based on the data we've unpacked today, what is your true risk tolerance? And more importantly, are you willing to take action to ensure your savings aren't slowly making you poorer? Use this framework to build a blueprint for 2026 that actually puts your money to work. Thanks so much for joining me on this explainer, and as always, keep learning.